If ever there was a time for clear, concise, and actionable guidance for investors, this is it. The Trump administration just revealed its big tariff plans. Nations around the world are responding with their own moves, and economists on the right, the left, and everywhere in between are weighing in on what it all means. I'm committed to helping you get the big picture right, and that's why in this week's Money Show MoneyMasters podcast, I've invited two of the nation's leading chief investment strategists to join us. They have the expertise, the know-how, and the actionable recommendations to put you on the right track here at the start of Q2 and also for the rest of 2025. Here's Stephanie Link of Hightower Advisors and Kathryn Vera of StoneX. Thank you both for joining me. Okay, so this is it. This is the big week where we finally gotten this news on the trade and tariff front. I know markets have really been waiting for it for some time. So I wanted to start the discussion with kind of the big picture there. What are your thoughts on what the administration has been doing and sort of how it's going to impact markets? And I guess, Stephanie, I'll start with you if you'd like.
Sure. So it's great to be here with you and Catherine. I think, look, I mean, I know there's a lot of uncertainties, and the market doesn't like uncertainties. But the market always climbs a wall of worry. In fact, I worry when we don't worry because that means we're complacent, right? So, look, these are unknowns, and they're real. We don't know the impacts of what they're going to do for the consumer, which is 70% of the economy. We don't know what it's going to mean for corporations, pricing power, what that means, and overall what it will do to earnings. So I kind of step back, Mike, and I just simply say I do not think we're in a recession. With the tariffs, without the tariffs. Right now, we are not in a recession. We're probably in 1.5–2% GDP growth at this point in time. And I will say that because in the last couple of weeks, the economic data, the hard economic data, is supportive of that. We're seeing green shoots in some parts of housing. We still have a long way to go, but lower interest rates will solve a lot. We have industrial production that came in better than expected, durable goods that came in better than expected. Even people were wondering about retail sales and questioning the softness. You still grew 3.1% in retail sales year over year. And then lastly, the consumer has a job. Wages are running at 4 to 5%. Inflation, I know, is still sticky and high, but it's come down quite a bit. I know we all complain about egg prices. The egg prices are dropping like a stone, and gasoline is down 10% year over year. And finally, maybe spending is kind of moderating a bit, but the savings rate as a result is up 4.5%. You add it all up, and you're still growing at 1.5 to 2%. And we'll have to see in 6 months, 12 months, what the tariffs do mean. Does it mean further slowdown? It possibly could, but I still think in a 1.5%, 2% growth world, you can do something like 7 to 10% earnings growth. And that's what I care about as an equity portfolio manager. It's because we know stocks follow profits on the way up and on the way down. And 7 to 10% growth is a pretty impressive number.
Thanks a lot, Stephanie. Kathryn, seems like a fairly optimistic kind of assessment of where things stand. Where do you come down on all this when it comes to the trade and tariff situation?
Well, Mike, we do have some precedent. Remember, this is Trump 2.0, so it's a sequel to the first movie. And we saw with Trump 1.0 in 2018, there were threatened tariffs of something between 60 and 100% on China. And we effectively got an effective tariff of 12% on China, which has been in effect from 2018 to today, added on to by the last administration. The same Fed, the Federal Reserve, came out with its own analysis quantifying pretty clearly the impact on core PCE from that first round of Trump tariffs, and they weren't overwhelmingly negative for inflation. So my argument here is that as Stephanie said, we don't quite know, but we have some historical precedent. And I'll tell you what those numbers were. The Fed's own analysis showed that President Trump's first round of tariffs in 2018 to 2019 added 0.5 percentage points to core PCE over the next year. Subsequent to that year, the effect diminished. The impact did remain on intermediate goods, but this time is different. And this time is different. I hate those words, but this time actually is because supply chains have diversified. So in the Trump 1.0, the supply chains hadn't quite diversified yet, but now they have. So the impact will be less persistent on intermediary goods than we saw in 2018. That to me says that the direct impact of tariffs, which everyone knows are going into effect tomorrow, um, will be more on financial markets than directly on inflation. There's a lot of debate about this, Mike. I just came back from Park City where we had our fixed income summit and was discussing this with a lot of institutional portfolio managers and other economists like myself. And there's a steep division between how important this will be for inflation and those who think maybe it's less relevant on a persistent basis than the scaremongers would lead you to believe. So my bottom line is, I agree with Stephanie. There's a lot of uncertainty, but we do have some precedent. And I'll add one other analysis, which came from Goldman Sachs, which said for every 4 percentage points effective tax rate, which tariffs are taxes, increase, it could shave between 1% and 2% off of earnings growth of the S&P 500. So I think that the more direct implications are on financial markets rather than on core PCE or any CPI, in my opinion, really. But this is what the Fed looked at, core PCE, or economic activity. I mean, that is what history has shown us. Of course, this time, could be a different situation, but that would be my main takeaway.
Got it. Well, Tom Hayes, when I had him on the other day, kind of said Wall Street can eventually deal with and price in both bad policy and good policy as long as it knows what policy will be. And I'm kind of curious how much you think of the tariff fears are just the uncertainty aspect and how much are real legitimate economic questions or earnings related questions.
Well, I would say that first and foremost, I think that without getting into politics, Trump was actually voted in based on the fact that he wanted to lower the deficits. So if you take universal tariffs at 20%, that's kind of like a big picture number, like that actually would be $538 billion a year in revenues to the US. So you can see why Navarro has been on tape all week long saying we're going to get 600 billion a year in revenues and we're going to get this deficit down and all that sort of thing. So look, we don't know all the numbers at this point in time, and the implications, but that's the one main goal. Remember why they're doing it, and also to bring manufacturing and company businesses back here, which kind of just I want to just like segue into how do you play that actually? Well, how do you play that if you're onshoring and reshoring and you have supply chains coming here and you have company facilities coming here? That actually is very good for the economy over the long run. It's not great on profits for the companies because it's obvious more expensive to do business here than in China or elsewhere. But they are diversifying around the world as well. U.S. companies, they will figure it out. It's just now that you have the known, we can move along. And on that theme of onshoring and reshoring, it has everything to do with, if you believe that we're in early innings of AI, which I do believe, I think the three of us probably do, then you need data centers. And I think the concerns over overbuilding data centers is totally overdone. We only have 5,400 data centers in this country. We're going to get to 10,000 by the end of the decade if you believe in AI, and you haven't upgraded the grid in over 50 years. And you need the grid for data centers. And you also need the grid for EVs, by the way. So there's this company called Eaton Corp, and I talk to them pretty frequently. They said that 70% of the grid is over 25 years old.
Wow.
So just think about that, right? Okay, so then you go, well, if you have the grid, what do you need the grid to? How does it operate? You need power, and we are undersupplied in power. So I'm trying to take all this tariff stuff and channel it in a corner and see what actually is it going to mean to the U.S. Over time. It's not going to happen overnight, but over time. And I think if I had to tell you and the audience, that's one of my favorite themes for the next decade.
Great. And I definitely want to get to one or two of the other themes that you mentioned. But first, I want to pivot, Kathryn, and ask you a question. We just wrapped up Q1. When you look at the performance, I mean, Treasuries outperformed the S&P for the first time since 2020. NASDAQ, I think the NASDAQ 100 had its worst quarter since 2022. All these weird things happen, including U.S. markets vastly underperforming a lot of the developed and emerging markets. What are your thoughts on what happened in Q1 and what it says about going forward? Is this kind of just a weird quarter, or is this sort of pointing to how things might go over the course of the year?
It reminds me of about 3 years ago. Remember, we had 1 quarter of negative growth. I think it was back in 2022, and we could very well see another 1 quarter of negative growth. GDP nowcast just came out from Atlanta Fed this morning, and it's very volatile, but it's showing negative 3.7%, quarter-on-quarter growth for 1Q of this year, and a lot of that has to do with a few things. One is front loading of imports because of tariffs, and that would not be a persistent phenomenon. It's a one-time thing, but also we've seen a decrease in capital investment from the 5 different regional Fed banks. So there is some deterioration in real data. We saw January data for real spending come out negative. So I think the uncertainty surrounding tariffs, if it were to be prolonged, and Mike, you touched on this, which is, either do it or don't do it. So if it's kind of this wishy-washy, let's see if we do it, let's retrace, then that could affect consumer sentiment, which, as Stephanie mentioned, is consumption is 70% of the U.S. economy. So that's highly relevant. So if there is some clarity on April 2nd around what the rules of the game are, then corporations can adjust, and they effectively do, because we're a very dynamic economy. But I did want to mention one other thing, Mike, which I think is important, which is Stephanie alluded to, which is productivity. And productivity has been our saving grace. Productivity has been booming, and that can absorb higher inflation rates, especially when you see unit labor costs being somewhat low. I would say that there's one other thing that keeps me more positive than others, which is the crowding in versus the crowding out phenomenon. When you have the crowding out of the private sector, which is what we have right now with massive fiscal deficits of 6.5% of GDP, with an economy that's growing at or above potential for the past 3 years, this is probably going to be the 4th year, because I agree we're not in a recession, or going to have one this year. That's an economy that is crowding out the private sector. The public and the private sector compete for the same pool of capital. So if the U.S. government is issuing debt as a necessity to cover these fiscal deficits, then they're forcing up interest rates for the private sector as well. So that leads to lower potential growth. That leads to lower return to shareholders, lower investments for the private sector. And this is a very bad and pernicious phenomenon for an economy that like ours. So I think, and I commend probably this crowding in phenomenon, which is what I think the Treasury Secretary President is looking to achieve, and that could implicate slower growth. And I think the administration is full on and ready to assume that slower growth to be able to achieve that crowding in phenomenon. So I think that if there is some success with regard to the fiscal deficit, rather than blowing it out, reining it in, hopefully that's the direction we're going, then we could see more upside down the line after a bout of volatility. So bottom line, and to answer your question most directly, Mike, I think the best play right now, and what I've been telling our investors is, this was several months ago, and we didn't have a spook in the markets. Buy puts on your SPY, buy puts on your triple Qs, and that serves as insurance policy in the event of correction. And I do think that that's what we're seeing now, and I wouldn't be surprised if we were to see a bit more of downside. I tend to think they're buying opportunities. I believe in the productivity and AI story, but I think that the Mag 7 has probably been tapped out, and we want to look for additional second round effects on other sectors from the AI principle.
Perfect. Stephanie, I want to go back to one of the kind of subsectors you mentioned earlier, and that would be housing, and I guess more broadly real estate even. I mean, if we have that crowding in phenomenon, if we have, the interest rate scenario that's a little more benign, what are your thoughts on what that's going to mean?
Well, we've gone from 7.4% 30-year fixed to 6.7, and I suspect after this week will be 6.5. And you have seen green shoots in existing home sales, in starts, in new home sales. It is nowhere near where we need it to be, but it is the first series of data that hasn't been absolutely horrible, right? So it starts that way, right? It could be like less bad, and then it's like, all right, like less bad. And then it's like, oh, maybe it's actually good. And then maybe it's really, really good. So it's all incremental baby steps. So housing, I think the main point is it's under a lot of pressure, and has been because interest rates have been so high, not because there hasn't been demand, because we are 5 million homes short, homes in this country. And if you talk to any home builder, which I do, they will tell you they have underproduced for 15 consecutive years. They would rather buy back their stock than build homes, excess homes. They know that their industry is very cyclical, and they have learned, very much like the energy sector, they kind of got religion too with their free cash flow. Instead of only doing drill, baby, drill, they took free cash flow, started to return it to shareholders and buybacks and dividends. So the home builders are doing the same thing. So in the meantime, they're trying to I don't know. They're trying to manage this challenge. But in the end, when you have the shortages that we have, plus, by the way, 5 million millennials are looking to be first home buyers. If you can get interest rates, in my mind, if you can get it to 6, maybe even less than 6, I think you will have better demand. You may not have those people that don't have a mortgage, or those people that have a 3% mortgage, which we know there's a bulk of them. Is about 60% of homeowners that have a mortgage. It's under 3. You may not have them coming into the market, but you do have another whole set of cohorts, and by the millennial generation, and then of course you're going to have the Z's as well, which is even bigger than boomers. So I think there's still opportunity if you have a long-term time horizon. I think you want to be in the home sector some way. Is it home improvement? Is it the home builders, or is it the materials companies? But I still like that sector.
Yeah, well, it has to be interesting. You got a company like Rocket that's out there throwing money around in a sector, mortgage financing and real estate. I imagine they wouldn't be doing that if they thought the business was going to be terrible.
For sure.
Kathryn, I want to pivot back to you and just, whether it's from sort of a sector standpoint in the stock market or even asset class, something like gold, precious metals. What are some things that you really like here? I know you mentioned healthcare, I think, in a recent segment.
Yes, yeah, and last year was utilities. This year I like healthcare. Utilities, we nailed it last year, and that was the reason I liked utilities was because it's a defensive, but it also benefits from the AI boom, of course, because as we know, AI and ChatGPT require inordinately more energy consumption than a typical Google search. But also I liked it because it was a defensive. This year I like healthcare because if the markets resume their move to the upside, and I do think there's a good chance of that. I have 6,600 for year end on the S&P. Then I think healthcare, being the worst performer last year, could be part of that all boats rise narrative. But I also like it because it is a defensive. So in times of volatility or downside, then in theory it should do well. So I think that's what I like. Gold, I've been a big gold bug for some time. It's done remarkably well. And I think that we probably should be looking at short duration treasuries. I don't love the long duration viewpoint yet. So I think we want to stay short and hold some cash and maintain those option strategies around equity positioning.
Great. One of the reasons we're all speaking, in addition, of course, to getting your insights, is that you're both going to be joining us for the Money Show Masters Symposium in Miami that's coming up in mid-May. I'm looking forward to catching up there, and I wanted to see, for anybody who's watching this, maybe if you could each give a preview of the kinds of things you think you might be talking about, even with the caveat that it's still a few weeks out. Stephanie, I guess I'd start with you.
Sure. So I think in this downdraft, you have to be buying high quality companies, number 1 or number 2 companies in any given industry that's truly on sale. So while the S&P 500 is only down 5% year to date, it feels a lot worse. Growth is down 11, value's up 1, and we know most people don't own value. I'm a core manager, so I own a little bit of both. We also know that the Mag 7 are down 25% from their highs, and they are trading at much more reasonable multiples, generating huge amount of free cash flow. I don't own very many Mag 7s, but I actually think that something like a Meta, which is number 1 in the industry by far, growing 20% earnings, operating margins at 40%, and trading at 20 times is quite interesting. So I think there are areas within Mag 7, within tech, you can take a look at. I think that, as I mentioned, there's a whole AI industrial infrastructure way. That's a really great theme. Animal health, I'm probably putting on my Peter Lynch hat because I have 3 animals, one sitting right next to me, and I spend more money on those 3 animals than I do on my 18-year-old. And we're going to spend $150 billion a year between now and 2030 on animal health. Cybersecurity is another area. I think cybersecurity is bigger than AI. And I think that you're going to see massive consolidation in that industry. We have 4,000 cybersecurity companies, and I think you're going to see the big five get bigger. So many other areas. I like financials. I like energy. I think the point being is there's a lot of places to choose. And when the market gives you prices that you're scared about, you should take advantage of it, especially if they are blue chip, large cap quality.
Perfect. Great advice there. Kathryn, a couple of themes maybe that you think you're going to be bringing to the table or that you think might be important to talk about in May?
Well, I'm really excited to join Stephanie. She's wonderful, and it's going to be a fantastic money show here in Miami, where I'm based. And so I look forward to that, Mike. I would just say probably the other thing that we haven't talked about much is the Federal Reserve and how much they're going to cut. Because I imagine, Stephanie, that you think they are going to cut. I just wonder how much that affects the story if they stick with this inertia idea of basically, I don't know, so I'm not going to do anything. But I think that we're probably going to see, and we already are seeing, a surge in military spending globally, from Europe to the U.S. China's certainly ramping it up. So I like industrials. I agree on the financials thought. And I think that we do need to be diversified and protect positions, protect earnings that we have in portfolios. So there are ways to do that. You want to look for low correlated assets. There's not many of them. And do remember, right now, when you have high interest rates and high inflation, then you have a positive correlation between treasuries or fixed income and equities. And that's important to remember, because usually we have that 60-40 portfolio, but that hasn't worked. It hasn't worked. So equities and bonds have moved in the same direction. And unless we get inflation down and interest rates down, that's not going to change.
Got it. Well, listen, Kathryn, Stephanie, I really appreciate you both taking some time out to share your insights here. Viewers, if you're watching this, again, both of these strategists are going to be joining us at that Money Show Symposium in Miami. It's in mid-May, May 15th to 17th. Not going to want to miss what they have to say there. So check out the event details using the link in the description. If you're ready, go ahead and register. Again, thank you so much for your time. Appreciate it today.
Thanks,
Thank
Mike.
you. Thank you very much.